A lot of people tell me, Philip, I don't want to buy into a life insurance policy that I'm not going to get my premiums back at the end. And I would say, well, there's a little bit more to it than just that. And in this video, I'm going to explain exactly why term life insurance is probably the best option for the majority of Canadians and why permanent life insurance isn't right for most people. However, I'm going to also tell you where permanent life insurance works very, very well. Make sure you stick around to the very end of the video because I'll tell you exactly who that person is and it might be you. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians buy the right life insurance at the right price, all from the comfort of their own home. So if that sounds interesting to you, I'll put the link in the description below. But without further ado, let's get right into the video. All right, let's just go over some basics here. Basics of term life insurance versus permanent life insurance and who is that right for. So term life insurance is the easiest type of life insurance to understand. You can pick a term. It's a term 10, maybe a term 20, maybe a term 30, maybe a term to 65. And during that period, you pay your premiums. And if something were to happen to you, your beneficiaries would receive a face amount known as a death benefit. Now, here's the thing. What do you do when that term life insurance is up? You really have three options. Option number one, you could cancel it and then maybe shop the market for another policy at that point that might be cheaper. Option number two, you can renew it with that insurance company if they have that renewability feature, which most insurance companies do. And that's going to be a prescribed rate. So it's already in the contract. It says we will renew it for another term. And again, if you had a term 20, it would renew for 20 years. If it was 30, it would renew for 30. So you can't downgrade from a 30-year to a 10-year on that renewal. However, the benefit to a renewal is essentially no matter what your health state is at that point, they're contractually obligated to renew that policy. So if you did have some health conditions that arise, I don't know, you would still be able to purchase life insurance at that point or renew it for another term. Now, the third option is you could convert it into a permanent life insurance policy if they had that convertibility option. Now, permanent life insurance, who is this right for? Well, permanent life insurance is not a what if, it's a when, because now it's going to pay out no matter what. It's meant to cover you until the end. So I would say for this, it's really good for those individuals that are looking at estate planning. They're looking at taxes upon death. They're looking at maybe passing something behind to the next generation, or maybe they had a disabled child and they know that they're going to have to take care of that individual for the rest of their life. So permanent life insurance is probably the best option in those cases. However, here's the thing. A lot of advisors out there say, well, maybe you shouldn't waste your money on a term life insurance policy. Maybe you should buy permanent because you're going to get it no matter what, and you can invest in it. And then during your retirement, you can pull a retirement income from this quote unquote life insurance strategy. Let's talk about that. If we're going to be comparing term life insurance to permanent life insurance, whether you use it as investment or not, we need to look at the prices. So I'm going to read off a few things here. So term life insurance, like I mentioned, is incredibly inexpensive, and permanent is incredibly expensive compared to term. So here's an example, okay? If we did a $500,000 term 20 for a 30-year-old male, that would cost us $30 a month. If we bought that in a permanent life insurance policy, it would be $450 a month. That's almost a 15 times multiple. So what do you get for that extra added component of permanent life insurance? Well, like I mentioned, you of course get it when you pass away, no matter what. So if you are that individual that is looking towards estate planning, you know you have hefty taxes and you know you want to leave something behind maybe to a disabled child, then it could be a good idea. But let's talk about that investment component. So here's how it works. Within permanent life insurance, whether you get whole life insurance or universal life insurance, there's something known as the cash surrender value. So whole life, it's cash surrender value. Universal life, it's known as account fund or fund value, just a little bit slightly different name. However, you can most easily think about this like the equity within your home. That's the easiest way to think about it, okay? Because just like the equity within your home, you can't just get a debit card and it's not a bank account. You can't just go out and say, yeah, I'm going to buy some groceries with this and I'm going to, buy a car, whatever you want to do with that. You need to get a loan against it, right? It's just equity, okay? But if you sold your house, they would give you that equity back, of course, because you're selling your house. It's the same with permanent life insurance. So there's really three ways that you can get the equity, the cash surrender value within your permanent life insurance policy out. Well, the first way is you can surrender your policy. Okay, well, that's really simple to understand. You can go to the insurance company and say, hey, you know what? I don't want this insurance anymore. Just cancel it and pay me out whatever the cash surrender value is. That's one way to do it. However, that will trigger a taxable event in most cases, and you're going to have to pay taxes on that income that you receive. And that's not a really good option. The second option to access that cash surrender value is what's known as a policy loan. A policy loan is where you're taking a loan directly from that insurance company. And the rates on that are anywhere from, 4 to 6%, somewhere in that range, depending on what kind of interest environment we're in here in Canada. Now, here's the thing with policy loans in Canada, though. Policy loans in the States are not taxable. Policy loans in Canada can be taxable. And it really depends on what year you're in within your policy. If you're in the early years, it's probably not going to be taxable. If you're in the later years, it could become taxable. So now you're probably thinking like, well, wait a second, I have to pay taxes and I have to pay interest on my own money. That doesn't sound like a really great idea. I wonder how that works. The third option that you can get income from your life insurance policy or access that equity is what's known as a collateral loan. Now, a collateral loan is where you'd go to, a third-party lending institution, RBC, Scotiabank, BMO, any of these lending institutions, and you say, hey, I have this asset here. Can I pledge this asset to you? And can you just give me a line of credit on this? And they say, yeah, no problem. Here's the thing. There are a couple differences between policy loan and collateral loan. Policy loans, like I mentioned, 4 to 6% could become taxable. However, here's the benefit to them. They are usually guaranteed to give it. They have to give it to you. It's your own money. And they're saying, yeah, absolutely. Here you go. Here's a loan on your cash surrender value. Okay. So it doesn't really matter what your credit worthiness is. And it also doesn't really matter what the amount is. If you had $3,000 in cash surrender value or $5,000 in cash surrender value, it doesn't matter. They're going to give you a loan, a policy loan on that, pardon me. A collateral loan, on the other hand, there are some benefits to it. And the biggest benefit is collateral loans here in Canada, as of 2023, is not taxable. No matter what, it's not taxable. I shouldn't say no matter what. There's some weird circumstances maybe involving a corporation where it could become taxable, but I'm not going to talk about that in this video, okay? So it's not taxable. That's the first benefit. And also the interest rates are quite preferential. That's the second one. So you're probably thinking, well, that sounds great. Why don't I just always go and get a collateral loan? Here's the thing about collateral loans is they can be difficult to obtain. So they want to see two things. Number one, they want to see credit worthiness. So you need to have good credit. You need to make sure your debt service ratio isn't too high. And you, of course, need to qualify for it. And the second one they want to see, most lending institutions will want to see significant more cash surrender value before they start to look at giving you a loan. So maybe that amount is $50,000, maybe it's $100,000, maybe it's $500,000. I will tell you this, there's not a lot of lenders here in Canada that like to give collateral loans for anything less than $500,000. I'm not saying there's none, I'm just saying there's not a lot. And when you start to get amounts that are lower than that, it can become just not as preferential as loans that are bigger than $500,000 or even $1 million in cash surrender value. Those are where the lend institutions really like to give loans on because, of course, it's a large amount and they make lots of money. So I say, yeah, we'll give you preferential treatment. We'll give you good interest rates. We won't put that many restrictions on it and you can go on your way. When you start to get into these lower amounts, it just doesn't become as preferential. So you're probably thinking this sounds like an incredibly complicated strategy, and I'm not going to argue with you. It is very complicated and there are a lot of things that you need to manage. So let's talk about these different things that you need to manage. There's 4 biggest variables, in my opinion, of why this strategy can be very complicated. So number one, you need to make sure that you continue to afford the premiums. Any benefit within this strategy will be 100% negated if in the early years, maybe year 1, year 2, year 5, year 10, you have to cancel this policy because you can't afford it anymore. You'll probably 1, lose a lot of the value that you put into this policy, and 2, there may be a taxable event because you're essentially surrendering your policy at this point and you may have to pay taxes upon that cash surrender value. So if you are looking at this type of strategy, you want to make sure that you will be able to afford it in the long run. Number 2, you need to make sure that the dividend scale or the returns you get are going to satisfy whatever illustration, whatever strategy you're trying to achieve. If an advisor came to you with this strategy, you want to say, hey, okay, so this looks great. However, let's stress test it. And this is a problem that a lot of advisors in the industry will do is they won't show the client any type of stress test. What do I mean by that? Well, within a whole life policy, there's something known as the dividend scale. All that means is essentially they're saying, okay, we've made this amount for the past 30 years, and we hope to be able to give this to you based on our past performance. That's what's known as the dividend scale. And usually there will be the guaranteed value and the dividend scale. If your advisor hasn't shown you this, ask them to show you the -1 table and the -2 table. What does that mean? It essentially means that let's run this illustration and let's stress test it if the insurance company earned -1% essentially over the next 20 years or 30 years. And let's see what that looks like. And if you start to stress test it, if it's not preferential at -1%, that means that if the insurance company only get 1 less percent return, your entire strategy could fall apart. So you want to make sure you're stress testing it to make sure that it still works if you are in that -1 or -2 environment. The third thing that you need to manage is the interest rates. So there's interest rates when you take out your policy loan. Now there's a couple different ways you could do this upon retirement. You could either pay that every month and that will just essentially satisfy the interest rate, or you could do what's known as collateralization. What does that mean? All that means is you're tacking on your overall bill over to your death benefit. So you're saying, hey, here's the loan. I'm not going to pay interest on it. Just capitalize it. And it just keeps continuing to pay more and more. And then upon death, whatever I have left as a loan, just pay that off with the death benefit, and whatever is remaining goes to the beneficiary. So that is an option. Your whole life is still going to grow in value as you take that loan. That doesn't affect it. So it can grow at a percentage that might be on par with that interest rate, and you may be able to pay that off and still have a lot left for your beneficiaries, but it's something to manage? Which leads me to the fourth thing that you need to make sure that you manage, which is this. This is an incredibly complicated strategy, which can be very beneficial for a certain group of people. However, for the vast majority of Canadians, it's not beneficial. So if you are in this category where it is beneficial, there's one more thing you need to manage, and that's your advisor. You need to make sure that you are working with an advisor that is in this industry for the long term, because as you can see, there's a lot of things to manage and there's a lot of strings attached to this, and you want to make sure that when you want to use this strategy, when you want to pull an income from it during retirement, your advisor is going to be there to help you navigate it, help you with the loan, help you manage your policy, help you change it, to different funds if it's a universal life policy. And if he's not there or she's not there, that's a bad sign. So if you are considering this strategy, talk to your advisor, ask them how long they've been in the industry, ask them what their long-term plans are. If they've only been in the industry for like 1 to 3 years, find another advisor. I'm sorry. Most advisors, I'm talking 80% of advisors, fail in this industry in their first 5 years. It's just a matter of fact. It's a hard industry to stay in. So make sure your advisor's been around for 5+ years and they have long-term plans to stay in this industry until you retire. So is permanent life insurance worth it? Well, I would say this. For people that are looking at estate planning, they're looking at passing something behind to the next generation, it could be a good idea. For people that are looking at it as an investment, it can be an incredibly complicated vehicle. It's sometimes a good idea for the high income earners that have already maxed out their RSP, maxed out their TFSA, they don't have any high interest credit card debt, and they're looking for other tax strategies. I made another lengthy video where I detailed apples to apples comparison, RRSP versus this, and you can clearly see that a simple RRSP will just destroy this strategy. However, if you've already maxed your RSP, this can be a wonderful, wonderful strategy that works very, very well. If you guys are interested in that video, just drop a comment below asking for the Invest in Life Insurance comparison video, and I will send it to you. I hope that I answered a lot of your questions about why permanent life insurance or how permanent life insurance isn't necessarily the best option for most Canadians. If you guys have any questions, just drop them in the comments below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.